Keeping money in cash feels safe. It feels responsible. It feels like control. But over time, holding too much cash quietly works against you, even if you never make a single bad decision. The problem isn't that cash is useless. It's that cash slowly loses purchasing power. Prices rise, assets grow, and money that stays still falls behind. The cost isn't visible day to day, which is why it's so easy to ignore. Many people think risk only exists when investing. In reality, risk also exists in not investing. When money sits idle for years, it doesn't participate in growth. Businesses expand, infrastructure improves, technology advances, and cash doesn't benefit from any of it. The goal isn't to eliminate cash. Cash has a job, but that job is short-term stability, not long-term growth. A practical way to think about this is to give money roles. The first role is protection money. This is cash set aside for emergencies, short-term needs, and peace of mind. It should be easily accessible and stable. This money is not meant to grow. It's meant to protect you from stress and forced decisions. The second role is growth money. This is money you don't need in the near future. Its purpose is to participate in real economic activity and long-term value creation. Growth money should be placed in ownership-based investments, things that grow as businesses and assets grow. Broad equity-based investments are commonly used because they provide exposure to many strong companies at once instead of relying on a single outcome. The key is balance, not extremes. Holding no cash creates stress. Holding too much cash creates stagnation. A simple starting point is to keep enough cash to cover short-term needs and give peace of mind, then assign the rest a long-term purpose. Another common mistake is waiting for the perfect moment to move money out of cash. That moment rarely arrives. Markets move constantly, and waiting often means missing long periods of growth. A calmer approach is to move excess cash gradually into long-term investments. This reduces emotional pressure and avoids all or nothing decisions. Doing nothing with money is still a decision, and it has a cost. Cash feels safe in the short term, but long-term progress requires participation. Once cash is assigned its role correctly, investing becomes clearer, calmer, and far more intentional.